My name is Eric Loftus, and I would like to talk about the 3 lines of defense Wealth Dimensions has to combat market volatility. We have seen a fair amount of volatility in recent years, from U.S. political pressures to inflation concerns to geopolitical events. All these events create uncertainty, and the market doesn't like uncertainty and responds with volatility in the short term. Behavioral finance showed that it's human nature to want to sell and stop the bleeding when you see portfolios go down. History has proven that this is often the worst course of action. Trying to time the markets and get in and get out of the market has proven to be a fool's errand and is not sustainable for long-term growth. So if timing the market is not a reliable strategy, what is Wealth Dimensions doing to combat all this volatility? We construct our portfolio to weather the storm, with asset preservation, maintaining buying power, and long-term growth as our primary goals. We also employ 3 strategies to accomplish this. The first line of defense is the fixed income or bond component of our portfolio. The second line of defense is diversification in our stock portfolio. The third line of defense is our rebalancing strategy. As I mentioned before, the different components move at different rates. On the bond side, we use them as dry powder to deploy into depressed stocks and get an outsized return when they recover. The same works on the stock side. We trim the stocks that have done well and redeploy them into the stocks that got hit. There are many additional highly technical aspects I could go into, but at its core, it is a systematic approach to the old adage, buy low, sell high. I was talking with Tom and Doug the other day when we talk about volatility, and a lot of their clients don't sweat times like this because they've been through them so many times. They've had these conversations with the advisors, and there's a real level of trust there because we've had the same conversations. We've stayed the course several times, and just like many other geopolitical events, political events, anything that might impact the market and cause periods of unrest, there's a recovery after that. It's really about making sure that you're set on what your plan is, and you can see, hey, when we model out, hey, what happens if there was a 15% downturn in a year? And you know, hey, I'm okay. I can live off the bond side of my portfolio and never have to touch or sell a stock during a downturn. That's one of the biggest things, is tying the investment plan to a financial plan and the moments in life that happen. That is really important, and really what we do differently than a lot of other firms. And then checking in when those things happen, and reestablishing how that affects the plan. And as returns happen, as real life happens, our plans are live action. They adjust to what's happening, and we can go and say, hey, what if this happens? Or now that happened, what does my new plan look like? And it's not, you don't have to build a whole new plan again. It's simply, hey, where are we at now? Do we need to make any adjustments? And go forth and strategize on the best outcome. If you have any questions or would like to discuss any of this further, please reach out to me or any member of the Wealth Dimensions team.